Good afternoon, I'm Lyn Adams.
I'm Justin Gross.
I'd like to welcome you to this edition of Video Insights, our second quarter conference call. I'd like to remind you also that nothing we talk about today is intended to be investment advice. It's strictly for educational purposes, give everybody an update on what's going on in the investment markets. So with that, we'll get started. I guess it's fair to start off with just returns, how are we doing this year? As we look at the different returns in the world markets, interestingly enough, the international pieces are outperforming the U.S. We haven't seen that in years, right? So emerging markets are up 11.5. The developed markets are up 7.4. Our U.S. large cap stock index, S&P 500, is up 6.1. The small cap's up 2.5. Bonds are barely positive, and then the commodity pieces are negative so far this year. I think there's one of the things to note is that energy prices are kind of backing down a little bit, and that sort of hurt the commodities piece. But all in all, good first quarter.
Yeah, I think it brings home the point that you want to remain diversified, even when it doesn't feel good. International has lagged, global has lagged U.S., but there will come a time, and maybe it's starting here. Now, who knows where it goes from here, but that outperformance is something that we haven't seen in a while, like you said.
Yeah, definitely. Let's look a little closer here at just the U.S. market. We always like to show this graph of the S&P 500. What you can see here is that we've definitely broken out of this trading range. We are no longer range bound. Ever since the election, we've seen the market move noticeably higher. It's been able to maintain that higher level. One of the things that I always pause is when the price to earnings ratio gets above 18. Historically, the average price to earnings ratio for the stock market is between 16 and 17 over the long run. But when it gets up to 18 or higher, that's when historically we've had some big corrections. So we actually touched 18 briefly in the first quarter, but then it's back down last few weeks. So around 17.5 times earnings. But overall, it's slightly above average for valuation. The dividend yield is stronger than it's been historically, so that helps it to have some basis. And it seems to be kind of going, staying in a pretty tight trading range right now as well. So one of the things that we have to look at when we talk about U.S. stocks is growth. Like, what is the growth potential from here? And I think the gist of today's call, I hope that everyone can take away from it, is that although we've seen some stock market price appreciation in the last 6 months, we need to remain focused on what are the drivers for growth in our economy and realize that it's not great. We've got a GDP throughout this entire expansion where the gross domestic product's only growing at 2.1%. Historically, in the U.S., it's been closer to 3% or even higher. And the reason for that is you've got so many people leaving the workforce. You still have over 10,000 baby boomers each day retiring, and that's taken a lot of folks out of the consumption cycle. So if you look at the components of GDP, consumer spending is almost 70% of GDP. So our ability to grow our economy is to some degree population based, and I think that we have to be very conscious that if we only grow GDP at 2% and the dividends are around 2%, then that's really going to only produce a total return expected for U.S. stocks around 4, right? And then you have to subtract from that any kind of management fees or internal expenses or trading costs, right? So we want to continue to look around for places to earn clients, a total return that's a good number. And we have to look outside the U.S. when there's not growth in the U.S. Right?
Yeah, and when we kind of do some of this forecasting, that's not to say that there's no pockets of opportunity around the world. Right. I mean, there's a home country bias in almost every country. They're individual investors, and it's no different in the U.S. U.S. investors are U.S. dominated in their portfolios. It's one of the most expensive, according to valuation, markets in the world.
Right.
So buy low, sell high. Maybe some opportunities out there in other places.
I think people are just more comfortable buying shares of stocks and companies that they see every day, right?
It's what you know. It's where you live. It's who you are.
Another issue with economic growth that we're facing right now, and this is sort of to take a little bit further step. If you look at our employment situation, we've grown the total number of jobs in this country since the Great Recession back in 2008. But at the same time, we've had more and more people become not participating in the labor force. And again, the largest part of this decline in labor force is the aging population. The boomers are getting older. So the more of them that you retire, the more of our total number of people in the economy are not working creates less opportunity for our economy to grow. And I think a lot of people, just don't really understand that we can't grow without something to give us growth, and people is a part of that, right? If we look at another piece of earnings growth is from oil. Now, there's a lot of data on this slide here for those who are looking at the PDF that we sent out. But if you look on the bottom left, what you'll see is that as the inventories of crude oil rise, typically the amount of rigs that are pulling oil out of the ground go down. It's supply and demand. One of the things that's happened here in the last 12 months that I think is a bit unanticipated from the oil industry and the analysts from the industry is that the active rig count is actually rising again. So you've got already a heightened amount of inventory of oil, and now you have more rigs coming online. So we think that's going to give downward pressure to oil. If that downward pressure for pricing continues, I don't think we will see oil go back to anything like it used to be. You know, it was back at $100 a barrel, $130 a barrel, years ago. I think we're going to be pretty tight in this $50 a barrel range. And if that happens, that's earnings. Energy is a part of the S&P 500. So if those earnings don't rise because prices rise, that's another headwind for the U.S. stock market, in terms of earnings growth. When we look at that in a broader picture, we look at earnings in the general sense. This chart here on the left shows what analysts at the companies, at the S&P 500 companies, are projecting earnings to be over the next year or two, continue to be positive. But if you look on the right, which we're isolating energy there, you can see that the energy industry is expecting earnings growth. But if the rig count rises and we end up with too much oil, that's not going to happen. And so I think that could be setting up the market for a disappointment in earnings. And then obviously investors would potentially sell off if earnings don't come through as they've anticipated for the next 12 months. So that's something we're very concerned about at this particular moment. Another headwind that we face right now is interest rates. We've been talking about interest rate risk for, it seems like half our career now, right?
A long time.
A long time because interest rates have been so low. But they are rising, and the Fed is now in a path to raise rates. And, it may not hurt stocks. There's been a lot of data that shows how does rising interest rates affect stocks, and it depends on if your economy is overheated or not. But I do think it hurts bonds. If you're a bond holder, which is an enormous market, and you own long-term bonds, rising interest rates can hurt you. But this is a projection of what the Fed is anticipating moving interest rates to going forward throughout 17 and into 18 and 19. I mean, they're going to continue to push rates up. So we need to be conscious about how that might impact the bond side of the balance sheet. Here's a chart here that would show you sort of the hypothetical outcome of 1% rise in interest rates, right? So if you had a 1% rise in interest rates, notice the things that get hurt the worst. Your 10-year treasuries would lose 4 to 6%. Your 30-year treasuries would lose 14 to 17%. I don't think a bond investor is prepared for that.
Well, typically you buy bonds for one of or two reasons, safety or income. And if you're buying that bond for safety and you have a lot of interest rate risk, the safety may not be there.
Right.
However, you can't get rid of bonds completely, because if we have an economic event or a global terrorism event, something that spooks the market, that flight to safety is going to be like a life jacket for your portfolio. So it's a tricky time in bond investing right now.
Very difficult to navigate. If you look here on this same chart, at the bottom, there are some types of bonds that don't carry interest rate risk. Convertible bonds, they convert to stocks at a certain price. High yield bonds, which take on more credit risk, or floating rate bonds, which actually float with interest rates. Those types of bonds don't tend to have interest rate risk, and we like owning those types of bonds in a rising interest rate environment. But what none of those three categories of bonds do is give you the protection of the flight to safety mentality. When the stock market's troubled, people sell stocks, they go run into high quality government bonds, and none of those three would generally be the recipient of that flow of money. So from a diversification standpoint, it's difficult for us to use those three categories of bonds as a diversifier to stocks that we own.
Your bond needs to act like a bond when it's time to act like a bond.
So we tend to have in most of our portfolios right now a mixture of intermediate duration, high quality bonds, as well as some pieces in the convertible high yield or floating rate space. But just, it's worth talking about because that part of the portfolio, as you like year to date, bonds are at barely over zero while stocks are up. The reason they're lagging is because rates are rising. Right? Let's turn the corner and talk about something maybe more positive, global growth. One of the things that we see right now that if you look at the data is that outside the U.S., the world economy is really improving. We see growth picking up in Europe. We see growth picking up in emerging markets. We see growth picking up in Japan. So in all these places around the world that are major contributors to the world economy, things are improving. What's interesting, if you look at this chart on the right, where it says global valuations, this is showing you the average range for what people bid up stocks. So in the U.S., for example, right now we're at 17.5 times earnings, right, which is slightly above the long-term average. That little purple bar represents the long-term average valuation. But if you look at Europe, it's right in line at 14 times earnings with their historical valuation. If you look at Japan, selling well below their historical valuations, and even emerging markets are selling below. So from a value standpoint, if you like to be a contrarian, kind of the Warren Buffett style, buy things when people are fearful, sell them when people are greedy, there's opportunities here outside the U.S., and we're actually increasing our allocations to some of those regions slightly in most of our portfolios because we think there's actually growth and price appreciation opportunity there right now. Another way of looking at what's going on around the world is the manufacturing heat map. So this is a data set JP Morgan puts together. It's really kind of interesting. It shows you the increase or decrease in manufacturing output from all these different regions around the world. And right now, what you see is there's a lot of green on this map where everybody is increasing their manufacturing, which is a leading indicator of the stock market, except for maybe one or two places. Greece continues to struggle. Obviously, they've got some pretty severe financial woes. And then you also have a little bit of challenges like Indonesia. But most every region in the world is accelerating on their manufacturing output. And that is a great leading indicator for world growth. So again, another piece of data that helps us to support that we should probably own a little bit more non-U.S. at this time.
Yeah, I mean, it all comes back to buy low and sell high. And I think you may have a better opportunity to buy low internationally right now, globally at least.
At this moment.
At this moment, yeah.
We might get a big sell-off in the U.S. markets for who knows what, and then we would like U.S. a little bit more, right? You might get a big run-up in international and say, oh, now we don't like it as much. It's all about staying balanced, looking for value. One last thing we want to cover on the call, and we're actually going to do a session this summer on this, a deeper dive in this, is essentially some of the things that the Trump agenda is putting out there, and it's motivating investors to have behaviors. So 3 things in particular I just want to touch on with the Trump agenda. One is tax cuts. We hear a lot out of Washington about we want tax cuts for businesses, tax cuts for individuals. There's some challenges with actually implementing that. And I don't think that even with a complete Republican Congress, you're going to get too far, because if you look at this particular slide, if you look at the current federal budget deficit, even right now with no changes in the law, we're operating at a 2.9% annual deficit. Government's bringing in less money than they're spending. And that's projected to rise with no law change up to over 4% in the next 10, 15 years. And it's because of the Social Security payments that are going to be increasing and Medicare payments increasing as the boomers retire. Well, if you take a look at the accumulated deficits, the sum of all of those years of running at a deficit, right now our total accumulated deficits is about 77% of what we produce in 1 year in our U.S. economy. With no further tax cuts, that's projected to be closer to 88% in 10, 15 years from now. So if we create more tax cuts, then that makes this worse, right? So there's only going to be a limited amount of runway, we feel, that you're going to see significant tax cuts as a stimulus for growth, because we've already sort of got an overspending budget problem. Another area that's not talked about a lot is the impact of immigration reform. We hear a lot about the wall. We hear a lot about stopping terrorists from getting into our country. We hear a lot about making immigration policy strict. But I don't think people realize that if you look at what drives our economy, in the last 10 years, our economic growth is contributed by increases of workers. And it's a very small increase, 0.3% increase in our workforce, and also output per worker. In other words, productivity. Well, if we look in the next 10 years, and it's forecasted out, you can see the demographics and you can see capital spending and productivity tools. What we see is that the increase in our growth of workers is almost exclusively from immigration. It's from immigrant workers coming here. If we were to make immigration more difficult, then what you're going to have for the next 10 years is pretty much a 0.04% workforce increase. And that is a very, very bad recipe for growth. There is no growth, right? So we have to be conscious that, you know, the reality is if we really have very strict immigration policy, we're going to have an economy that is in decline. And there's no way to fix that. Right?
It's important to talk about immigration through this lens because most of the time it is national security, those type conversations that happen. But these are real numbers.
Right. It's really alarming. And if you look at the right-hand side, the drivers of GDP growth. I mean, historically, GDP is up over 3, maybe even 4% for many, many decades. Right now, we can get some GDP growth out of productivity gains. They're expecting, you know, maybe 0.9% for the next 10 years. But even best case scenario, you take the immigrants that are allowed in plus the workforce that remains, you might get 0.4% from population growth. GDP growth at 1.3% for the next 10 years, plus throw a dividend on top of that of maybe 1.9. You're talking about a total return in the U.S. stock market in the 3 range, right? That is not promising and not exciting. So we have to be very alert to when prices begin to get high, we need to take profits, and when prices fall, maybe that's the time to add. But just sitting tight and watching a 3% return over the next 10 years with some fees subtracted out of that to manage or trade, that's not really going to be a very rosy outlook. So we have to be more aware of some of these political items in terms of what might impact growth. So a lot of information there. We want to just kind of give you a little recap. So we're going to do a little financial market scorecard. All right. So the good things, we have low unemployment. If you want a job, you can get a job. All right. That's a great situation now. I think unemployment's still around 4%, and for the college educated, it's like 1.4%. So it's very low numbers for unemployment. We still have low interest rates, especially relative to history. Right? Mm-hmm. And even if they rise 0.5% or something, still going to be very low. Global growth is picking up, so there's going to be some opportunities for us to find some growth outside the U.S. And I do think that President Trump is going to continue to make headway on deregulation. Regulation costs us money, costs corporations money. If we can streamline some of that, there will be profits in our economy from that. So those are the good things. Bad things is obviously with unemployment so low, we expect to see wage inflation. You know, what you could go out and get somebody to do for $12 an hour, you can probably pay them $15 an hour, right? That's coming, right? The financial leverage in the balance sheets of U.S. corporations didn't really talk about this, but it's kind of high. There's a lot of leverage right now. People borrowing money to grow at a pretty high rate, and it's probably because they anticipate interest rates rising, so they want to lock in
get that
their
low
opportunity to leverage. But anytime you have a lot of leverage and things don't work well, that becomes a more systemic problem. Stock prices are kind of high in the U.S. At 17.5 times earnings, they're not alarming, but you know, they've been up at 18 several times this quarter, and that begins to be a concern, I think. And then obviously we've talked about the weak employment pool. I mean, we got to get jobs from somewhere. You know, what's going to happen if President Trump is able to create, you know, another 500,000 jobs, but there's nobody that's available to take them? Like, right. What does that look like, right? So those are some things going on in the markets. The conclusions from today's call is that even though slow economic growth is projected, you know, stocks could still provide better returns in bonds, because you could have negative returns in bonds pretty easily with rising rates. Intermediate term economic growth is not great. Long term, we continue to think there is a lot of good reasons to be invested. I mean, the millennial generation is a huge generation, and you know, they're going to replace a lot of those boomers probably 7 to 10 years from now in terms of the real workforce. I think it's realistic that the market could reverse the gains it's gotten. It's gotten pretty excited after the election and made us a little bit of money. But you know, if we get a stumbling block or some of these points that we just talked about become more obvious, that could reverse the gains. And then obviously there's other opportunities. We need to look abroad. I think that's the big pieces.
Yeah, and a lot of these headwinds, they're real and they're headwinds, but it's important probably to note that especially with in most of our portfolios with our defined risk strategy, that volatility can be a very good thing.
That's right.
If we sell high, then you want that opportunity to buy low.
Yeah.
So that this could be the volatility could be really good for us.
It could be. It very well could be, because we don't stay invested once the markets move below the 200-day moving average, and if we got a major decline and we have a lot of money, in dry powder, and then the market averages move down, and now we have a re-entry point that's lower. That's a good way to make money. It's just not comfortable for people.
It's not normal. But defense wins championships.
That's it. That's it. It is entirely the case. So with that, we'll kind of wrap up with our disclosures. We appreciate everybody that entrusts us with the opportunity to serve them and help them grow their nest egg. Stay tuned for more information about our summer event we're going to do on Trumponomics. I think everybody will enjoy that one. And with that, I'll turn it over to Justin to go through the required disclosures.
Keep in mind that while diversification may help reduce volatility and risk, it does not guarantee future performance.
All economic and performance information is historical and should not be considered indicative of future results. Investments in securities do not offer a fixed rate of return. Principal yield and/or share prices will fluctuate with changes in market conditions, and when sold or redeemed, you may receive more or less than originally invested. These views are those of Adams Financial Partners and should not be construed as investment advice. All information is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. Consult your financial advisor for more information.